Welcome to California Bar Prep, your study companion for the California Bar exam. In this lesson, high-yield trusts core rules. Let's begin. Trusts essays are fiduciary duty essays wearing an estate planning jacket. Once a valid trust exists, most points come from trustee conduct, loyalty, prudence, impartiality, accounting, delegation, earmarking, segregation, and following trust terms. California probate code rules supply the framework, but fact application determines the score. Think chronologically. Was the trust validly created? Was it revocable or irrevocable? Did the settlor amend or revoke correctly? Did the trustee administer according to the terms and fiduciary duties? Can the trust be modified or terminated? What remedies protect beneficiaries? Duty of loyalty. A trustee must administer the trust solely in the interests of the beneficiaries. Self-dealing, conflicts, secret profits, and transactions with trust property for personal benefit are presumptively improper. Good faith or fair price may not save classic self-dealing unless authorized by the trust, beneficiaries, or court. Duty of prudence. A trustee must administer the trust as a prudent person would, considering purposes, terms, distribution requirements, and circumstances. Investment duties are evaluated under the prudent investor rule using a portfolio approach, considering risk and return, diversification, liquidity, tax consequences, and beneficiary needs. Duty of impartiality. When a trust has multiple beneficiaries, such as income beneficiaries and remainder beneficiaries, the trustee must act impartially and balance competing interests. Impartiality does not always mean equality. It means faithful regard for each beneficiary's rights under the trust. Duty to account and inform. Trustees must keep beneficiaries reasonably informed, provide accountings when required, and allow enforcement of the trust. Failure to account often supports surcharge, removal, or adverse inferences. Breach of trust claim. Identify the trust and trustee duty. Show trustee conduct violating the trust terms or fiduciary duty. Establish causation and loss, or improper profit. Choose remedy. Surcharge, disgorgement, constructive trust, equitable lien, accounting, injunction, removal, denial of compensation, or tracing. Consider defenses. Consent, release, ratification after full disclosure, statute of limitations, trust authorization, or court approval. Prudent investor analysis. Evaluate the portfolio as a whole, not each asset in isolation. Consider purposes, terms, distribution needs, economic conditions, inflation, tax consequences, expected total return, other beneficiary resources when relevant, and special relationship of an asset to the trust purpose. Diversification is generally required unless special circumstances make non-diversification prudent. Delegation is permitted if prudent in selecting, instructing, and monitoring the agent. Modification or termination. Follow trust terms first. Settlor and all beneficiaries may often modify or terminate an irrevocable trust, subject to material purpose limits and statutory rules. Beneficiaries alone may seek termination if all consent and continuance is not necessary to achieve a material purpose. Court modification may be available for changed circumstances, administrative problems, uneconomic trusts, or tax objectives. Revocable trusts can be amended or revoked by the settlor using the method in the trust or statutory default methods if allowed. Charitable trust and cypres. Valid charitable purpose. Specific purpose becomes impossible, impracticable, or illegal. Settlor had general charitable intent beyond the failed specific method. Court modifies the trust to approximate the charitable purpose. Exculpatory clause versus no duty clause. A trust may limit trustee liability, but California courts scrutinize clauses relieving bad faith, intentional misconduct, reckless indifference, or profit from breach. A clause does not give permission to steal. Consent versus informed consent. Beneficiary consent protects the trustee only if the beneficiary had capacity, knew material facts, and was not improperly induced. Concealed conflicts or incomplete accountings undermine consent, release, or ratification. Self-dealing versus conflict transaction. Direct purchase of trust property by trustee is classic self-dealing. A transaction involving trustee's relative or controlled business may also be conflicted. Analyze loyalty even if price seems fair. Administrative deviation versus dispositive modification. Administrative changes alter how the trust is managed. Dispositive changes alter who receives benefits. Courts are more cautious with dispositive changes unless statutory requirements are met. The prudent investor rule does not require successful investments. It requires prudent process at the time of decision. Concentrated stock may be permissible temporarily, but requires reasoned analysis and monitoring. A trustee who is also a beneficiary still owes duties to other beneficiaries. Spendthrift clauses do not defeat all creditors. California recognizes exceptions, including certain support and public policy claims. A no-contest clause is enforceable in California only within statutory limits and generally requires probable cause analysis for protected contests. Do not forget remedies. Trust's answers should almost always discuss surcharge, removal, accounting, and constructive trust when breach appears. When a trustee buys trust property, loans trust money to herself, hires her own company, or takes an opportunity, lead with loyalty. State that self-dealing is prohibited, apply facts, then give remedies: rescission, disgorgement, constructive trust, surcharge, removal, accounting, and possible denial of fees. When a trustee keeps all assets in one risky investment, lead with prudence and diversification. If the trust holds family company stock or a personal residence, consider whether special circumstances justify retention. Discuss process: investigation, advice, monitoring, and documentation. Liability turns on prudence when acting, not hindsight alone. When beneficiaries seek modification, identify who consents and whether a material purpose remains. If the settlor is alive and consents, modification is easier. If only beneficiaries consent, a spendthrift, support, or discretionary purpose may be material and block termination. If circumstances changed in a way the settlor did not anticipate, court modification may preserve the trust's purpose. When a charitable purpose fails, do not let property automatically revert. Analyze sine precedent. If general charitable intent exists, the court can redirect property to a similar purpose. If the settlor had only a narrow, specific intent, resulting trust to settlor or estate may be possible. A high-scoring trust's answer combines probate code concepts with equitable remedies. State duties clearly, apply facts closely, and end with beneficiary relief. That's it for this lesson. Download California Bar Prep on the App Store for lessons on all 14 bar subjects, practice questions, and essay frameworks. Keep studying, and good luck on the bar exam.